Welcome to the Deep Dive. We're here to cut through the noise and get straight to the insights that, well, really matter.
That's the plan.
So today, we're diving into something in finance that looks simple on the surface, but oh boy, it gets complicated fast. We're talking capital gains and losses.
Oh, yes, classic.
You'd think the rules are the same for everyone, right? Sell an asset, make a profit, pay the tax. But what if I told you that same profit or loss gets treated completely differently depending on who you are? An individual versus a corporation.
That's exactly where the confusion often creeps in. It's a really significant difference.
It really is, and it can trip up even people who've been doing this for a while. So today, our mission is to sort of untangle these rules. We're going to focus specifically on those key differences, individuals versus corporations.
And it's not just academic stuff, right? This has real-world impact.
Absolutely. If you're making investment choices, advising people, or maybe, studying for the CPA exam or the enrolled agent exam, these differences are prime testing material. They really want to know you get it.
Yeah, understanding the nuances is critical.
Okay, before we really jump into the deep end here, just a quick reminder. Everything we're discussing today, all the details, the examples, it's based on material from Farhat lectures.
Right.
All the content comes from the resources over at farhatlectures.com. So if you're an accounting student, a CPA candidate, or even a professional wanting a refresher, definitely check out the website. They've got extra practice questions, video lectures, loads of support to really hammer these topics home.
It's a great resource.
Big thanks to Professor Farhat for providing all this valuable material for us to work with.
Absolutely.
All right, so to really get why the corporate side is so different, let's first lay down the basics. How do capital gains and losses work for individuals? That's our starting point, what most of us probably deal with personally.
Okay, yeah, good place to start. So for an individual, the first thing you do is called the netting process. You basically lump all your capital gains together and all your capital losses together for the year.
You offset them.
Exactly. You offset them to get one single number, either a net capital gain or a net capital loss for the year.
Okay. And if it's a gain, what happens then?
Right. If you end up with a net gain, the next question is, how long did you hold the asset? If it was less than a year, that's a short-term capital gain.
And that gets taxed like regular income.
Pretty much, yeah. Short-term gains are taxed at your ordinary income tax rates, whatever tax bracket you fall into, which currently goes from 10% up to 37%. Of course, those rates can always change.
Always subject to change, right? But what about the ones you hold longer than a year? That's where the good news usually is for individuals, isn't it?
That's the key difference for individuals, absolutely. If you hold an asset for more than a year before selling at a profit, that's a long-term capital gain. And these get preferential treatment.
Lower tax rates.
Much lower, generally. The rates are typically 0%, 15%, or 20%. Which specific rate applies depends on your overall income level and, other tax details. We won't get into all that today, but the big point is individuals get a tax break on long-term gains. It's a clear incentive to hold investments longer.
Okay, that makes sense for gains. But what if the netting process leaves you with a loss? Say, an investment just didn't work out. Can you use that loss to, lower your taxes on your job income or something?
Yes, you can, and that's a really important benefit for individuals. If you have a net capital loss for the year, you can deduct up to $3,000 of that loss against any kind of ordinary income.
Any kind, like W-2 wages.
Yep, W-2 wages, self-employment income, interest income, whatever. Up to $3,000 per year can directly reduce your taxable income. That means real tax savings.
Okay, $3,000. But what if your loss is bigger than that? Say you lost $10,000.
Good question. The $3,000 is just the annual limit against ordinary income. If your loss is bigger, like your $10,000 example, you use $3,000 this year, and the remaining $7,000 isn't lost.
It carries over.
Exactly. It carries forward to the next tax year. And you can keep carrying it forward indefinitely until it's all used up.
Indefinitely, wow.
Yeah, and crucially, those carryover losses keep their original identity. So a long-term loss stays long-term. A short-term loss stays short-term. That matters when you eventually use them to offset future gains. It's a pretty flexible system for individuals.
Oh, so individuals, preferential long-term rates. $3,000 loss deduction against ordinary income, indefinite carry forward. Got it. Now, let's switch gears. Corporations. This is where it gets really different, right?
Prepare for a bit of a shock, maybe.
Does that preferential rate for long-term gains stick around for corporations? My gut says no.
Your gut is absolutely right. This is probably the biggest difference on the gain side. Corporations get zero preferential tax treatment for capital gains. None.
Wait, zero? So if a corporation holds stock for, say, 10 years and sells it at a profit, it's taxed the same as if they sold it after 10 days.
Exactly the same. It doesn't matter how long they held the asset. Corporate capital gains are just treated like any other income, like revenue from selling their products or services. It all gets lumped together and taxed at the normal corporate tax rate.
Wow, so that whole short-term versus long-term distinction we just talked about for individuals, completely irrelevant for corporations.
Completely irrelevant from a tax rate perspective. Since there's no special rate, there's no need to distinguish based on holding period for tax calculation purposes. It simplifies that part, I suppose, but it means no tax advantage for long-term holding.
Why the difference, though? Is there a reason tax policy treats them so differently on this?
Well, the thinking often goes something like this. The individual preferential rates are there partly to encourage personal long-term saving and investment. Corporations, on the other hand, are seen primarily as, well, business entities. Their investment activities are often part of their core operations, so gains are just treated as business income. That's the general idea anyway.
Okay, I can see the logic there, even if it feels a bit tough on the corporation. All right, so gains are different. Now, losses. If gains are taxed higher, I'm guessing losses are harder to use.
Oh, you are definitely on the right track. This is where the rules get really restrictive for corporations, and it has huge implications.
So can they use that $3,000 loss against ordinary income like individuals?
Nope. Absolutely not. Corporations cannot deduct any capital losses against their ordinary business income. That $3,000 allowance, purely an individual thing.
So what can they do with capital losses? If they have a loss and no capital gains that year, does it just sit there?
It can only, and I mean only, be used to offset capital gains. If a corporation has, say, a $50,000 capital loss but zero capital gains in the same year, they get no tax benefit from that loss in that year. It can't reduce their tax on operating profits at all.
Okay, so the loss doesn't disappear, but it's stuck unless they have gains. What if they don't have gains that year? Can they carry it over like individuals?
They can carry it over, but the rules are much, much tighter. There's a two-part process: carry back and carry forward.
Carry back, so they can go backwards in time.
Yes. First, they must carry back the loss for up to 3 years. They have to apply it to the earliest year in that 3-year window first. So if they have a loss in 20 by 3, they look back to 20 by bliss. Did they have capital gains then?
Ah, and if they did, they can use the loss now to offset those past gains.
Exactly. They'd amend their 20 by tax return, apply the loss, and potentially get a tax refund for taxes they paid back then. Then they move to 20 by 1, then 20 by 2, using up the loss against any gains they find.
Okay, so carry back 3 years first. What if there are no gains in those 3 years, or the loss is bigger than the gains they had?
Right. If there are no gains to offset in the prior 3 years, or if there's still some loss left over after the carryback, then they can carry forward the remaining loss.
And how long can they carry it forward?
How?
Indefinitely.
Nope. That's another key difference. Corporations can only carry forward capital losses for 5 years.
Only 5. So 3 years back, 5 years forward. That's it. If they don't have gains in that window, the loss just, poof, expires.
That's exactly right. If they can't use the capital loss against capital gains within that 3-year back, 5-year forward window, the loss expires worthless. It's gone.
Wow. That's incredibly restrictive compared to individuals.
It really is. Oh, and one more technical point. When these losses are carried back or forward for a corporation, they're always treated as short-term capital losses.
But you said short-term versus long-term doesn't matter for corporate tax rates.
Correct. It doesn't affect the tax rate because there's no preferential treatment anyway. It's more of a classification rule for tracking purposes within the tax system. The main takeaway is the strict limitation only against gains and the limited carry back forward period.
Okay, this is a lot clearer now, but seeing it with numbers would probably help. Let's use that example from the source material, Adam. What happens if Adam has a big capital loss? First as an individual, then as a corporation.
Perfect. Let's make it concrete. So the scenario is, in the year 20 by 3, Adam has a net long-term capital loss of $8,500.
Okay, $8,500 loss. First, Adam the individual. Let's say Adam has a regular job, plenty of other income.
Right. So Adam the individual takes that $8,500 loss. First step. Can he use it against ordinary income? Yes, up to the $3,000 limit. So in 20 by 3, he deducts $3,000 against his, say, salary income. That lowers his taxable income for the year.
Okay, so $3,000 used. What about the rest? That's $5,500 left over. $8,500, $3,000.
That remaining $5,500 is carried forward to the next year, 20 by 4, and it keeps its character as a long-term capital loss. In 20 by 4, he could use it to offset any capital gains he might have, or if not, he could use another $3,000 against ordinary income, and so on, year after year until it's all gone.
Indefinitely. Got it. Clear path for the individual. Now,
Yeah.
the plot twist. Same $8,500 net long-term capital loss in 20 by 3, but this time it's Adam the corporation.
Okay, Adam the corporation has this $8,500 loss. Step 1, can it offset ordinary income in 20 by 3?
No, we just established that. Zero deduction against operating profit.
Correct. So in 20 by 3, that loss provides no immediate tax benefit against ordinary income. The corporation must then look back. They look back 3 years, 20 by 0, 20 by 1, 20 by 2. They must start with the earliest year, 20 by 0.
So they checked their 20 by 0 records. Did they have capital gains that year?
Let's say they did. Maybe they had $10,000 in capital gains back in 20 by 0. They would then use the $8,500 loss from 20 by 3 to offset those 20 by gains. They'd file an amended return for 20 by 0 and likely get a tax refund. The loss is now fully used.
Okay, but what if they had no capital gains in 20 by 1 or 20 by 2?
Good scenario. If there were no capital gains in the entire 3-year carryback period, then the corporation can't use the loss looking backward.
So then it carries forward.
Then the entire $8,500 loss carries forward, but only for 5 years, 20 by 4, 20 by 5, 20 by 6, 20 by 7, and 20 by 8. If Adam the corporation doesn't generate at least $8,500 in capital gains sometime within those 5 years to offset this loss,
it expires. Gone forever.
Gone forever after the end of 20 by 8 in this example. That potential tax shield just vanishes.
Wow. That example makes the difference incredibly stark. So bringing it all together, what's the big picture takeaway for someone listening, whether they're a student, a pro, or just trying to manage their own finances?
Well, the core difference, the thing to really remember, is that split treatment. Individuals get those potentially lower tax rates on long-term gains, plus that handy $3,000 annual loss deduction against any income, with losses carrying forward forever.
While corporations
Corporations get none of that. Gains are taxed at regular corporate rates, just like any other business income. And losses, way more restricted, only usable against capital gains, and within that tight 3-year back, 5-year forward window.
It really highlights how tax policy shapes behavior, doesn't it? Incentivizing long-term holds for individuals, but treating corporate investments more like regular business.
Absolutely. It's not just a technical rule. It reflects different policy goals and has massive real-world financial consequences. It shows how the form of the entity, individual or corporation, can totally change the financial outcome of the exact same transaction.
It really underscores how vital understanding these details is, doesn't it? This whole deep dive, looking at gains and losses for individuals versus corporations, it's about more than just tax regs. It really makes you think about how fundamental that choice of legal structure is.
Definitely. It impacts everything.
It's not just about liability protection. It hits the bottom line directly through taxes. And it raises a bigger question, maybe something for you to think about after this. If the rules for capital assets are so different, where else does just being an individual versus a corporation totally change the financial game? Think about things like, I don't know, health insurance deductions, maybe retirement plan options, even how selling your home is treated. It makes you realize just how layered the financial world is, all depending on structure. Something to definitely keep exploring.